Hello, everyone. So we are back for another weekly recap. And so let's just jump right into it. So, what was interesting this week is the stock markets actually did really well, which definitely is opposite of what I thought was going to happen. So, just to kind of level set everyone. So, last weekend, we knew that Iran and Israel were officially at war. The US was having talks of intervening or interjecting themselves into the situation. And so, of course, I had assumed, like many finance people, thought that once the markets opened on Monday, the stock market was going to take a hit. Now, the reason for that thought process is whenever there is war and a lot of uncertainty, Wall Street doesn't like that. And so people, well, few things. Wall Street gets nervous, doesn't like it, but also retail investors like you and myself, when people begin to get nervous about the economy or what's going on in the globe, they start to panic sell. And so when people are panic selling and selling off their stocks in their portfolios, whether it's their IRA, their 401k, what have you, that is what causes many stocks to begin to drop in value. And that also impacts the overall stock market. So for me, as a finance professional, I just kind of knew the markets were going to take a hit. Definitely, I thought there would be a big drop going into the trading day on Monday. And then there would be a lot of volatility throughout the week until we kind of knew what was going to happen between Iran, Israel, and the US. But surprisingly, the markets actually did really well. So I'm going to share my screen so we can look at this together. Okay, let me come back here. But it was very interesting to see, to say the least. Now, I'm of course happy I was wrong. And the reason why I say that, I had an Anarchy person leave a comment on a post that I made on Sunday night. And they were like, what did they say exactly? Let me go back and let me pull up this post. And it's one of those things where when you are posting on social media and you are a public figure, the things you just hear and see and get subjected to is quite interesting. So let me see if I can find this post. Total sidebar, not really, well, it's kind of related to the conversation. So this person said, name is David Green, by the way, left the TikTok comment and said, couldn't have been more wrong. Nice call. And it's always interesting because no one ever has all of the answers and no one ever knows exactly what's going to happen. And that's the whole premise of investing in finance. Everyone, including myself and all the fancy schmancy, highly paid hedge fund managers, we're all making educated guesses. We're leaning in on professional experience and education. We're also leaning in on personal experience and things that you've seen in the past, whether it's trends, looking at history, and we're taking all of this information to make a guess. Because truthfully, they're all guesses, right? As to what's going to happen next. And everyone's trying to be as directionally correct as they possibly can be. But no one has a crystal ball, no one knows everything. So on Sunday night, when I made that post, I was going off of, again, my professional and personal experience, what I have seen in trends in the past. So that is how I came to the conclusion that the markets were going to take a hit on Monday and be volatile during the week. Now, while on one side, there's myself and many others who felt that, I'm sure there were others who felt the complete opposite. And that's the whole premise of investing. Every person who thinks they should be selling, there's someone else who feels they should be buying. And right, you are never going to be right 100% of the time, but you want to be directionally correct. And so I'm glad that I was wrong. And I know that might sound weird, but no one wants to see the stock market take a hit. But again, the reason why I put up that post was to have people just brace themselves for what's ahead. And when we have times like this, people don't always correlate what's happening in the news to their pockets, at least not directly. So you could have been watching the news and hearing everything going on with Iran and Israel and not really connecting the dots to say, oh, this might impact my 401k this week. This might impact my retirement and my IRA. People don't always connect those two dots. So for me, as a finance professional who posts on social media, it's just one of those things to say, hey, just think about this and just be on notice that this may happen. So anyway, that's just my little tangent for the day. So anyhow, let's look at the S&P. I think I'm sharing my screen. Let me come back here. Okay, I am. Fantastic. I'm back to using my large monitor. So if you see me looking to the side, I'm looking at my large monitor. I love this thing. So here is the S&P 500. And we'll look at the performance over the last 5 days. So what we're seeing here is the market is up a little bit over 3% in the last 5 days. And truthfully, this is the a complete opposite of what I thought we were going to see this week. And this is a real life example of where I had an educated, you know, assumption and I was wrong. And that's the other part too. I don't claim to always be right about everything in the market. The whole point of my channel and my content is to educate, to bring awareness, and to have people feel more empowered and confident as they move through their investing journey. And that's the whole point. I'm not here to be right all of the time. I'm here to educate, and that's 100% of the time. So anyway, if you look at the stock market, the S&P 500, it had a nice run this week. I think it's almost at a record high. Don't quote me. So this is great. And to be truthful, it's kind of weird to see because we have so much turmoil going on overseas. We have inflation hitting us hard here at home. We're seeing tons of company layoffs. Unemployment is increasing. And we have this ongoing conversation about tariffs, right? So to see this as the result this week, very interesting. And I'm still trying to like dig into it to understand the why. Now, the reason for me, the why is important because this now could be a new trend. And also, is it the overall market or are there pockets within the market that are doing well that's driving this increase to happen? So something I'm still digging into. And of course, as I figure it out, I will let you guys know. So with that being said, one of the other main concerns this week, due to what is going on overseas between Israel and Iran, is oil. And oil is definitely a big commodity that's used here in the US. And so Iran has control over something called the Strait of Hormuz. Hope I'm saying that right. This again. Yeah, I think I'm saying that right. So with the Strait of Hormuz, about 20% of the world's oil flows through that water channel. It is a major port of the global distribution of not only oil, but of liquefied gas. And so Iran had initially proposed to close the strait to all imports and exports. And of course, if that does happen, there are other routes that can be used, of course, but this will significantly impact the logistics and supply chain. And then that will also cause a big increase in the price of oil. And we're already seeing high oil prices. We're already seeing high prices at the pump. So to take a already increased number and take it even higher, it's going to trickle down into all parts of the economy that rely on oil and liquefied gas. And we're talking about, at least here in the US, we are now moving into a peak travel season. For many individuals, they're now on summer break, whether it's the kids that are in elementary school, high school, etc., college students, teachers, officials who are on vacation. People are ready to hit the road and enjoy their summer vacation. And so if we see this price in oil increase, it's really going to impact the summer travel and plus everything else in between. So as of right now, the strait is still open, but there is a possibility Iran will close it, and then we'll see the effect of what I'm talking about as far as the price of oil increasing, and then that impact the prices of goods and services. So something that everyone is paying attention to, everyone is watching, and I will of course keep you guys posted. So I'm gonna stop sharing for just a second here. So another big thing this week, we are finding out that buy now, pay later apps and your accounts will eventually impact your credit scores. Now, this is a big deal for a couple of reasons. So in the past, well, current day, I should say, unless you default on these loans, they are not reported on your credit report. And so now what FICO is proposing is these accounts will show up on your credit report as an active trade account, whether your account is up to date or not. And so this is going to be really problematic for a number of reasons. But before I jump into that, as of right now, what they have agreed on is they will report this information on your credit report. They're going to create a whole separate credit score model that takes these accounts. Well, it takes it into account into its calculations, and you will be able to see it on your credit report. What's currently up in the air is the FICO will allow these scores to be on your report. It will be up to the three credit bureaus whether or not they let potential lenders and creditors see this information. And that's the part that we don't have any clarity on just yet. And so the thought process behind including this on your credit report is one, there are so many Americans that rely on these buy now, pay later platforms like Affirm, Klarna, Afterpay, Sezzle. I'm sure there's more that I can't think of right this minute. And it's significantly increasing how much debt they have. And so when a lender is looking at your portfolio, not portfolio, at your credit report to see how much debt you have, they right now have no idea about these buy now, pay later debts that you currently have. And so, what these creditors are looking for is they ideally want to see these accounts to have a full accounting of your true debt to income ratio. And so, I think for some people, this could be a good thing if they don't have traditional credit like a credit card or a mortgage or a car loan. This could be a way for them to improve or increase their credit scores, but to also show their credit worthiness. So that's similar to like a secured credit card or those self funded loans and things like that. So it could be a good thing. But on the other hand, it could also be detrimental to people's credit and their finances. So if you're missing payments, if you're late on payments, if you're defaulting, and these creditors see that, that will, of course, negatively impact your credit scores. But also, it's going to increase your debt to income ratio, which not only one decreases your credit scores overall, is now going to show these lenders how much you are relying on these non-traditional credit lines. And you'd be surprised to how much debt people are in behind these buy now, pay later platforms. I saw a few TikTok videos where there was one woman, she's currently paying $1,200 a month to either Affirm or Afterpay. I forget which one. That's like someone's car note, that could be someone's rent, and that is just her monthly payments to one of these buy now, pay later platforms. And what makes these platforms so attractive, they give you the ability to buy more now than you can realistically afford. And I think where I kind of struggle with this is you can finance almost anything at this point. You can finance. So let's not forget like DoorDash and Klarna, they now have a partnership. So you could technically finance your McDonald's order. Now, obviously, there's more companies on DoorDash besides food. Like you can buy things from Dick's Sporting Goods and Lowe's, and I think even Home Depot and like Best Buy, Victoria's Secret, right? There's many other stores. So you can buy like big ticket items and finance them like you would like on a credit card, but you also can finance fast food. And so this is just showing how much we're relying on credit culture, but also shows how much people are struggling financially. So if you are really not having, if you're having a hard time right now, but you can finance groceries for your kids for the next couple of weeks, I get it. And you do this until you hope things turn around financially. But for many people, they're just digging themselves into a bigger and bigger hole. So yeah, so this new scoring model is going to go into effect in the fall. So think like September, October timeframe. Hopefully we will know more as we get closer. Now I did have someone leave a comment on one of my TikTok videos and they were asking, well, when they start this reporting, is it going to be effective as of just any loans from that date forward, or is the reporting going to be retroactive? And that's a very good question. And truthfully, I have no idea. The research that I've done thus far doesn't really speak to that. So I am going to keep myself up to date on this. And as I know more, I will, of course, report this to you guys. But that is definitely a fair question. So TBD on that. So now we'll jump right into earnings calls this week. So it wasn't an extremely busy week, but there were some pretty big name companies that did report their earnings. So we're going to first start off with Nike. Nike's results were quite interesting and definitely caught me off guard. So just to do a little recap, and actually let me pull up their P&L statement. I have it. Is this Nike? Yeah, this is Nike. So let me share my screen and we'll kind of talk through this together. I've got way too many tabs open. Just to level set everyone. So this is the press release that Nike published this week after their earnings call. And so I'm just going to jump to their financial statement. So Nike's fiscal calendar runs from June 1st and ends May 31st. So with this earnings call, they not only reported their Q4 earnings, they also reported their full year earnings. So just to kind of level set everyone on that. And so I want to bring your attention to the columns on this side. We're going to focus on the 12 months ended time frame. So we're comparing May 31st, well, the year ending May 31st, 2025 to the fiscal year ending May 31st, 2024. So first thing to show, revenue is down 10% year over year. If we look at their net income, aka profit, their profits are down 44%. That is wild. I did not expect that. I tend to look at Nike as a household brand that just always does well. Even if their revenues are down, I expect their profits to be down a little bit, not to be down over 40%. So, of course, that is a huge red flag. And so, what was interesting about their earnings call, they, of course, in black and white, you can't deny the results, but they were giving reasons as to why, right? So they're seeing the impact of increased costs due to tariffs, inflation, etc. But they had a positive spin on the call to say, okay, yeah, the numbers are bad. We know they're bad. They will most likely will be bad in Q1, but here's our outlook. So they were really focusing on the forward-looking statements and the things they plan to do to turn things around. So they're on this strategic business move to do that. And so, of course, in decreasing costs is one of their major concerns. They're also going to try new avenues to sell their products. So one big change, they will start selling Nike. Nike will have their own storefront on Amazon. That's huge. That is super huge. So I think that's the avenue they're going to right now, and it'll be interesting to see how that plays out. And so normally when a company has poor earnings results, their stock tends to take a hit. But I'm going to show you Nike stock, and you'll be surprised as to how Wall Street responded to their earnings call today. Well, not today. When was the earnings call? I think it was yesterday. So let's pull that up. Okay, so let's look at Nike. And so you will see, I think the earnings call was the 26th. So yeah, that was yesterday. Their stock is up about 15%. That's crazy. If I had this is another thing, if I had to guess what happened to their stock price, I would have assumed the stock would have taken a hit because of their earnings results because they were so poor, right? Revenue is down 10%, net profits down over 40%. That definitely gives doom and gloom. But I think the positive forward looking statements is kind of giving investors a lot of positive confidence in what Nike's going to do this year. And so it speaks for itself. So the stock is up 20% in the last 5 days, and it's up 15% in the last 24 hours. So very, very interesting to see. So yeah, very, very interesting. I did not expect to see that. And just for context, the 52-week range for Nike stock is the lowest stock price in the last 52 weeks is about $52. The highest price is about 91. So at $72, not a bad price. They also pay dividends, kind of low, but yeah, definitely interesting to see. So if you are a Nike investor, you are more than likely a very happy camper. So next, I want to switch to FedEx. So FedEx, they had a not so, it wasn't horrible. The results weren't horrible, but it wasn't great either. Let me see. I have is this their income statement here? I think so. I try to have everything pulled up before I start these lives. And yeah, this is FedEx here. So let's jump right into that. So FedEx also runs their fiscal year June 1st to May 31st. So their earnings call that was this week as well also is giving not only Q4 results, but is also talking about the full year results as well. So if we look at total revenue, revenue is relatively flat year over year. So nothing to speak about there. But their net income, aka profit, is down 6%. So that's this line right here, if I highlight it in blue here. So a few different reasons for Nike, not Nike, for FedEx's results. They too are significantly being impacted by the tariff situation. So as tariffs are making things more expensive, companies are essentially ordering less stuff, which means less shipments. And then on the other side of the equation is as inflation impacts the everyday consumer, and even businesses, whether small or large, small businesses, they too are unable to afford to just buy as much. That means less shipments. And so FedEx is feeling that. And so for this year that just ended, they had a cost cutting initiative about $4 billion, which they did meet their target, but it still didn't help their bottom line. So for this year, they're going to work on cutting an additional $1 billion. So, of course, that is going to be headcount reductions more than likely. They're also closing locations. I believe I saw they're planning on spinning off their freight division and making it its own separate publicly traded company and entity. So, very interesting to see. Now, FedEx, their stock Wall Street definitely responded negatively to these results. And I think the difference between FedEx and Nike, so both companies didn't have stellar results. And truthfully, Nike's results were worse than FedEx. But the issue with FedEx did not give any guidance on earnings and profits for this year. So because there's no insight as of right now, investors just feel, I guess, a little lost since there's no guidance, there's no speaking of how do you kind of turn things around. And you'll see in a second how that impacted the stock price. So when these earnings calls are happening, I know for some people it's like it's boring, it's not interesting, but a lot of information is being given on these calls, and investors take this information and they're making decisions based on it. So you could have bad results like Nike did, but if you can give investors confidence of what you're doing going forward, you can gain their confidence and they will continue to invest in your company. But if you're having crappy results and you're not giving any guidance, it's kind of like, well, do I stick around and keep my money here, or do I jump ship and take my money elsewhere? And that's why earnings calls are super important. Let's go back here and let's look at FedEx's stock for the day. Here they are. So their earnings call, I believe it was the 24th. As you can see, it's exactly when the stock price took a hit. It did rebound just a little bit. Now, I think the rebound is more so due to the announcement that was made after the fact, where they are cutting, they're doing a reduction of 30%. They're combining locations, and they're going to spin off their freight division. So I think that's what's kind of saving them here. But after that initial earnings call, the stock definitely took a hit here. So I think between FedEx and UPS, they definitely have, well, I think shipping and freight in general, they are going to have a tough time right now, especially with the things going on with the tariffs, particularly between the US and China. And until we kind of come to a decision on the tariff trade agreements, it's going to be a rocky road for these kind of companies. And also, while inflation is still remains an issue, and then to add on top of that, the oil situation. So if the oil prices continue to increase, that's also going to impact their bottom line as well. A lot of moving pieces, and the companies that find creative ways to navigate through all of this, those are the ones that are going to be extremely successful and will still be able to remain in business and remain profitable. So only time will tell. So last but not least, General Mills. So General Mills had their earnings call this week as well. If you're not familiar, General a lot of breakfast products. Think of like Lucky Charms, Kix, things like that. They also have a pet care division as well. And they too are having a tough time. Let me. So General Mills, they too have a fiscal calendar that goes from June 1st to May 31st. So in this earnings call as well, they too were not only disclosing Q4 results, they also were disclosing their full year results. And so for them, revenue is down 2% year over year. Not horrible, but their profits, their net income is down 8%. And so for General Mills, they have a few reasons as to why they're seeing a decrease in the revenue and profits. So, of course, for them, they also are dealing with the tariffs and inflation. And so with the inflation piece, consumers are just buying less. That's really what's happening. They also are seeing that customers are okay with buying private label, or I guess generic brand cereals and foods, and because they're cheaper, right? The pie is only so big, and so if you need to feed your family, and if your dollar can stretch a little more by buying the generic or the private label brands, you're just going to go that route because it may not be as good, but it's good enough. It helps you stretch your dollar. And so they're seeing a shift in consumer preferences and also just overall decreased consumer spending because of the economy. Inflation is high and people are becoming more discretionary on how they spend. They're being more picky, they're being more mindful. And a lot of that is due to the uncertainty between the economy being unstable, the job market being extremely unstable. People are pulling back, not only individuals, but businesses as well. And so for them, they are also going to go through cost cutting initiatives. So, AKA job cuts are more than likely going to be top of mind. And you're going to see a lot more companies saying the same thing. You're going to begin to see a theme as I go through these earnings calls week after week. It will sound like I'm repeating myself because companies are going to all start using the same playbook. When revenue is down, profits are down, the first line of defense, well, there's two lines of defenses, right? So one, they have to find ways to increase revenue. So when it comes to increasing revenue, you can increase the price of your goods or services, right? But then of course, that might cause your customers to take their business elsewhere, or they will still buy less. So that's always like a slippery slope. And the other thing is to decrease expenses. And unfortunately, your people costs are your most expensive component of operating a business, right? And so that's the first place they're going to go to. And I'm speaking from my professional finance experience. So you first start looking at open headcount, meaning positions you plan to hire. What roles can we just not hire? It was nice to have, but there's no one in this role anyway. Can we take the responsibilities and divide among the people who are already here? That's the first thing. And the next thing is, well, if we have to cut, just to give broad numbers, we have to cut $20 million, you start making the pie into smaller pieces to see, well, where can you cut? And so whenever you have job cuts, just know more than likely, I would say 9 times out of 10, it's not personal. And I've seen so many videos on TikTok where people, right, their lives are disrupted and they take personal offense to being laid off. And I will tell you, you can never take it personally. You are literally a name on a spreadsheet. Literally, it'll be like your name, your job title, your location, your salary. That's it. They don't look at, oh, well, so and so just had a baby. So and so just had a house, just bought a house. So and so just had a death in the family. So and so has 5 kids. They don't look at any of that. It's literally names, numbers, salary. And how can we get to this number that we have to cut? That's really it. Like literally. Now, sometimes they will look at performance, anyone on a PIP plan, anyone like who's a poor performer. Those are the low hanging fruit, right? When it comes to who has to go versus who has to stay. But you could be a high performer and still get cut. That's literally just how it goes. So never take job cuts personal. It's just a numbers game. It's just business. And I think the more people understand that, the less offended. It still sucks. It still hurts. It still messes with your finances, but it's never, very rarely is it personal. So, okay, we'll move off of that tangent for right now. But let's just jump to look at General Mills stock price. Let's see. Let's go back here. There you are. I should know this ticker symbol. I don't know why I had to search it. I know that ticker symbol very well. So if we look at General Mills, so their stock price is down about 5%. No surprise there, right? They just had their earnings call. They didn't have great results. Um, Now it's funny, they did have an increase in their pet food division, which was pretty interesting. Other than that, sales are down primarily here in North America. So Wall Street did not respond positively to their results. And so the stock is down about 5% this week. And they had to turn things around, but there are lots of unknowns with everything going on with the tariffs and everything like that, and oil. So it's kind of TBD on this right now. But what I will say, whenever a company has poor results, if it's a company that you believe in or you know their history, this could be a time to buy more shares because you know it's going to bounce back. But this is where your investor checklist comes into play that I talk about a lot. When you are looking to buy a stock, you need to understand what's important to you as an investor. So I always recommend to have 3 to 5 metrics that are important to you. And if that company meets those requirements, then you know, yes, you'll invest in them. Or if they don't meet your requirements, then you must decide, well, I don't want to invest in them at all, or it's a I will invest in them, but just not right now. And so having this checklist makes investing a lot easier, and it takes the mental load off a little bit, if that makes sense. And so in my ebook, The Stock Market Investing for Beginners, I do talk more about the investor checklist, and I do give you an easy way to learn more about investing in a way that's very easy to understand. And that's always my goal with my platform, whether it's TikTok, Instagram, YouTube here, is to make investing less intimidating, because it can feel intimidating. It can feel overwhelming, especially when you're trying to do things right. It's hard to sometimes understand what to do and what not to do because there's so much going on, there's so much information. But the goal is to always keep things as simple as possible so you don't feel overwhelmed and you don't let analysis paralysis get in your way. And that's the piece that stops many people from investing, because they're overthinking it for a few reasons, right? They're like, oh, well, what if this is a bad stock? What if I'm paying too much for it? I don't know what I'm doing, right? There's so many things that we say to ourselves, but you have to understand you're never going to know everything. You're just not. So investing is something where you have to kind of just start and figure it out as you go, like literally. If you don't know it all, that's great. You can learn. You can learn, you can learn, you can learn. So just start, and just start testing. I've been saying this a lot lately. A lot of investing is testing, right? You invest in this stock, you see how it does. Maybe you buy more or you buy something else. And you have to just write it out and just see how things go. But don't get in your head. Don't overthink. Just do the thing, and you can. It's all figure outable is a word I like to I like to use a lot, and then just kind of go from there. Um, and don't overcomplicate it, please. Please, please, please. So that is it for today's live. I think that was all the companies that I had that I wanted to cover for today. There's fire. I think there's fireworks going on in my neighborhood. If you hear that noise, it's fireworks. There we go. If you have any questions and you're watching the replay, feel free to put your questions in the comment section down below. I will come back and answer your questions. Also, if there's a topic you would like to see me cover in a future live or to add to this segment, also let me know in the comments. Getting your feedback is always important to me as a creator, so I can understand what you need from me to help you in your investing journey. So with that being said, have a great evening, have a great weekend, and I'll talk to all of you next week. Take care.